Good morning, I'm Benjamin Sullivan, and welcome to Market Monday for May 4th, 2026. May the 4th be with you. Over the past 3 years, the S&P 500 has mostly moved as a single block, dragged higher by the Magnificent Seven on a shared story: massive investment in artificial intelligence justified by rising cloud revenues. This week, we're going to look at why that pattern has held, what changed last Wednesday, and what it means for your portfolio. Let's start with the track record. The Magnificent Seven make up roughly 30% of the S&P 500, and in the past 3 years, they have driven the lion's share of index returns. Goldman Sachs estimates AI-related investment is driving approximately 40% of S&P earnings per share growth this year. Here's why it has worked. Each hyperscaler has been telling the same story. Massive data center spending is justified by accelerating cloud growth. When the story is the same, the outcome is the same. Now to last Wednesday, Wall Street braced for what some were calling Magsmageddon. 4 of the largest companies on Earth all reported earnings within minutes of each other, after the Fed's rate decision was delivered just earlier in the afternoon. The expected collision never showed up. The S&P 500 closed roughly flat. What happened underneath was different. All 4 hyperscalers beat expectations, and the market rewarded none of them equally. Alphabet, the parent company for Google, rallied 6% on cloud growth of 63% and $460 billion of backlog. Meta, the parent company of Facebook, raised its CapEx estimates to $125 to $145 billion, blaming component pricing and the Iran war. They fell 6% after hours. Amazon delivered the fastest cloud growth in 15 quarters and still fell 3% on collapsing free cash flow. Microsoft beat estimates and dipped as well. Same night, similar results, but 4 entirely different verdicts. We saw the same pattern at the Fed and in the Middle East. Jerome Powell's likely final meeting as Fed chair ended with rates held at 3.5 to 3.75% on an 8-4 vote, the most dissent since October of 1992. The consensus that defined the Powell era has come apart. The US-Iran ceasefire announced on April 8th was filed by the market as resolved, but Hormuz shipping volumes remain far below pre-war levels. The blockade is still on, and crude oil crossed back above $110 a barrel last week. The headlines and reality have diverged. 3 different parts of the market are all telling the same story. The Magnificent Seven is no longer moving as a block. The Fed is no longer a single voice, and the geopolitical headlines no longer quite match the operational reality. When dispersion widens, the benefits of thoughtful investment selection start to compound. This is the environment that disciplined portfolio construction is built for. It's a major reason we've been having more of these conversations lately about how the next phase of this market may require a different kind of portfolio than the last 3 years did. The question this week isn't about what you own, it's about what you don't. If you have only had exposure to US large cap companies, the next 3 may look very different. This is exactly the environment where diversification in real assets can provide the balance that the indices alone can't. Reach out if you want to walk through what that means for your plan. If you know someone who should benefit by hearing this, send this their way. That's all we have for you today. As always, thank you for watching this week's edition of Market Monday. Join us again next Monday for more of the insights that matter to your money.